Welcome back to another portfolio review video, and it's actually been almost 6 months since the last one. There's been a lot of changes with the new year, as you can probably already tell if you've kept up with my latest videos. For the markets, it's been a wild start to 2026, where we saw it started to correct a bit as the enthusiasm about AI spending waned. And then, everything continued to trade down further due to rising global conflicts and wars. Year to date, the S&P 500 is now up 3.90%, with the Nasdaq up a little bit more at 5.82%. It's just in the last 2 to 3 weeks where we've seen a very strong recovery in the markets, where it fully recovered from the bottom. In the S&P 500, it has been a 12.33% gain from the bottom, and then in the Nasdaq, it's been a 16.20% gain since the bottom. So in this video, I'll show you exactly how my portfolios have performed through all of this, along with what they currently look like in terms of the specific holdings for 2026 so far. If you want to continue following along the journey, consider subscribing for future videos. The goal for this year is 5,000 subscribers, so let's see if we can make it happen. And with that, let's get into the portfolio review. To start, for context, this is being recorded on April 17th after the market close. In the past, I went over the changes for all the accounts, but to make these videos a bit simpler, I'll skip over this part and only go over the performances of the actual TFSA and non-registered accounts themselves. Also note that the values here are going to be excluding the distribution amounts that have been taken out of the accounts for the semi-monthly payers. So the values in both accounts are going to be slightly lower because they haven't been paid yet. And with that, let's get started with a TFSA account. If you compare the last video update on the portfolio, you'll notice that the portfolio is now well over $100,000, compared to the $17,000 from before. But as I mentioned in the previous video on my 2026 plan, you'll know that I decided to liquidate and consolidate my TFSA all within Wealthsimple late last year. And because of this, there are a lot of technicals, or math, that needs explaining when looking at the returns or values you'll now see in this review due to the large influx of cash. There are also a lot of new updates within Wealthsimple too, so I'll also include some of those along the way. But to get started, there are now 2 new toggles for the chart that you can choose from. The first is the account value, and then the other is the returns. We'll start off with the account value first, because this will show you visually proof of the consolidation into the account. So by selecting the all-time view, I can then hover over the chart to show you the account history. Starting on the left, you can see the account was started on January 1st of 2025. Then over time, I slowly contributed to it, and then over-contributed by accident, where I made a withdrawal once I realized it. And starting this year with the new cash amount, I started contributing to it again in a really big way. Once I got the final confirmation of the 2026 contribution room in the TFSA, I then went ahead and deposited the remaining amount all at once, so that it could be put into a high-interest ETF while I slowly look to deploy it over time. Next, we'll switch over to the returns chart that will show us the actual growth of the account over time. So, on the one day, which is on Friday, April 17th, we have a gain of $797.45. On the 1 week, a gain of $3,534.39. Then for 1 month, a gain of $5,957.20. And on the 3-month, it was a gain of $2,877.64. For year to date, if I hover and start on the very left, you can see that the simple return rate at the top right is at 0%. Before this latest rally, the highest point was on January 13th, with a positive 3.57% return. Then, over the next few months, as we all know, there was the conflict, which saw the entire market start to decline. At its lowest, the simple return rate was negative 5.39% overall. But during this time, I was constantly adding and averaging down on my positions whenever there was a dip. So, as we move further to the right, we can visually see that the chart itself is now much higher than the peak of January 13th from earlier in the year. But even though it is much higher, the actual percentage value of the return is lower, now only showing a positive 2.23% return. And from the actual values, the current return is $2,600.65. This goes back to the total returns, and generally how they are calculated in most places based on the simple return rate. Because as I mentioned, I was regularly adding to the account and averaging down on positions during this time. When this happens, the actual base or denominator being used for the calculation increases over time, which will gradually bring down the percentage return value. I've already explained this multiple times in various other reviews, and have an actual video on it too if you want to find out more. But to quickly summarize it, let's say we invested $1,000 into a stock. The price then goes up 50%, and now your investment is now worth a total of $1,500, which is the $1,000 original investment and the $500 gain. So the calculation would be $500 in gains divided by $1,000 invested, which equates to a 50% return. Now, if you then invest another $1,000 into the stock, your total invested amount then becomes $2,000, which was $1,000 initially, and then adding this new $1,000. Your gain is still $500, because this new $1,000 invested hasn't had time to grow yet. So the new calculation would be $500 in gains divided by the now invested $2,000, which equates to a 25% return overall. Now, nothing new has actually happened to your returns, but it dropped by half or 25% because your base investment has doubled based on your newly invested total amount. This concept is important to understand, as this is exactly what has happened within my TFSA, as I contributed more to it since the start of 2026. If I go to the 1-year return now, it'll showcase this concept, or denominator effect again a bit more clearly. With the mouse on the left, you'll see that it's a 0% return. Then, at the peak during this past year, the simple return rate looks to have been as high as 63.35%. And at its lowest this past year, it was as low as negative 1.24%. By subtracting the two return values from each other, it would suggest that from October 29th, 2025 to March 30th, 2026, I lost 64.59% of my returns. Of course, if you were invested in highly volatile or penny stocks, you might see large swings such as this. But this wasn't the case for my TFSA portfolio, which was built to be more of a core allocation, like I had mentioned in my last video. This significant difference is of course because of all the new contributions I'd made since the start of 2026, where the value of my TFSA portfolio increased by more than $100,000 from my last update. If I continue to move to the right of the chart, you'll see how it quickly recovers and passes the peak of October 29th from last year. But even though we are now much higher, the return percentage is only 6.71%. So this here clearly demonstrates what happens, and has happened, to the return value of my TFSA, where it isn't that the portfolio is underperforming, but is a result of the new contributions that have been added to the account. Hopefully that helps with your understanding of these values that you now see, and also if you are wondering the same about the returns in your own portfolios. Now back to the review, going to the all-time returns, we start off on the right with 0% as usual. Then again at the peak it was a positive 33.42% return, and eventually dropping to negative 1.02%. And as of now, it is showing a positive 4.22% return. But on the left, it says it is a positive 5.18% return all time. So there is a bit of a discrepancy between them for some reason, but we'll just move on to the next part and look at the more detailed performance insights of the account. Here in the performance insights section, we can see that the portfolio value is $120,212.81, with the net deposits being $114,293.16. Then the all-time return is $5,919.65, with $1,125.42 of it being unrealized. In the overview section, we'll then again see some return values, but this time there's a different one called the time-weighted return rate. By hovering over the information icon, it gives us a definition for each one of the types of returns. The first two we've already gone through, or are pretty self-explanatory. The third one is then based on how your investments have performed, with the effects of deposits and withdrawals removed. And because we've had this account for over a year, it is showing here an annualized value of 13.16%. So if the S&P 500 index returns on average 10 to 11% per year, then this value means that we are slightly ahead in terms of the average performance. The next two sections below are the realized returns and dividends earned all time in this account. For the realized returns, this isn't going to change much as I don't plan to be selling in and out of positions too often. I've explained in a previous video why it's in the negative, but in short, it was due to some restructuring of the portfolio that I did in the past. But as you can see from the total returns, it more than covers those losses that were actualized. So it overall has been a net positive for those sales. And then for the dividends earned all time, it's now at $5,278.31, with most of it being received from HHIS and Q-Day. This will likely continue to be the case, as these two are some of the largest positions in this account, as well as the higher yielding ones. Now, to see the actual holdings currently in the account, we can go back to the previous page. Scrolling down, these are all the current holdings within my TFSA. For those of you who have kept up, you'll notice that there is now an additional holding with Brompton's new PAYG ETF. This is a newer ETF that was just released a few weeks ago, but its focus on global equities fits well with adding to the portfolio's international exposure. There were quite a few comments in the last video about this ETF, so if you have any specific questions about the strategy and details of this ETF, feel free to comment below, and maybe I can get in touch with them to provide some more clarity for you. But in general, if you look at the all-time returns, a lot of these now are in the green due to the rally these past 2 weeks. All of these in terms of total returns are positive when you include the distributions, except for INT, which is less than 2% away from being in the green. Because I've now added PAYG to the mix, I'm going to have to rebalance the holdings within the portfolio again, but most of these are approximately where I'd like them to be allocation-wise. And I still actually have a fairly large cash position waiting to be invested, which is currently being held in a high-interest savings ETF, as I slowly look for opportunities to deploy it over time. I'll get into some more of the details later on in my spreadsheet, but next, let's switch over to the non-registered account to see its performance as well. So like before, we'll start with the account value view, and take a look at the all-time chart so you can get an idea of the account history. I had actually opened this account with Wealthsimple for over a year, before actually depositing any money into it, and then actually making my first investments on July 21st, 2022. Over time, I continued to add more to the portfolio, with the net deposits starting to gradually dip in 2025 as I transferred money over to my TFSA. I've since started to add back some of those withdrawals, and the account now sits at an all-time high with this recent recovery in the markets. Now to switch over the view for returns. On the 1 day, it was a gain of $461.58. And on the 1 week, it was a gain of $5,860.71. Then, in the past month, it was a $6,573.85 gain. For the past 3 months, it was a loss of $1,931.08. And year to date, it has been a $3,999.95 gain so far. If I now hover over the chart, we start off with a 0% return at the beginning of this year. At its peak, the account was positive 6.29%, but eventually went down to minus 9.58% at the bottom before the recovery started. I did add a little bit during this time as things traded down, but not too much in this account. And as of today, recording this video, it's up 3.28% currently. Now looking at the 1-year return, it has been a $24,911.18 gain in the past year. Then finally, all time, this account has returned $41,683.86, or 59.42% so far. In general, I have a soft goal of trying to double the account value every 5 years for this account, because it's a bit more aggressive in nature. Right now, we're in the 3rd year, approaching the 4th anniversary, so I'd say that it's relatively on pace to meet this objective. Of course, keep in mind other factors like I've mentioned about adding more money to the account will reduce this value over time. So I wouldn't fixate on this goal, but it's nice to see and something to keep motivated with, knowing that the investment decisions I've made are working as intended. Going into the performance insights section, the portfolio value is at $111,833.99, with the net deposits being $70,150.13. Then the all-time return is $41,683.86, with an unrealized return of negative $1,946.69. For the overview section below with return values, the simple return rate, as we already saw earlier, is 59.42%. As for the time-weighted return, this one is currently a bit lower than usual, sitting at 10.33%, But it's still in line though with a typical S&P 500 average return of about 10 to 11% per year, so I'd say it's still doing fine. The lower rate of return, if I'd have to guess, would probably be due to the crypto holdings causing it to lag behind a bit. For the next section, I've realized a return of $12,507.01 so far in this account. I don't do any trading in this account, so all of these were from restructuring and swapping out of holdings over time. Then, for the dividends earned all time, I've collected $35,585.51 so far. All of this has been reinvested back into the account in order to continue growing the distributions and overall portfolio value. Now, to see the actual holdings within the account, we can go back to the previous page. Scrolling down, these are all of the holdings currently. I won't go over each of these individually as there are quite a few, and the next thing we'll be doing is taking a closer look into the personal spreadsheets that I've built for further analysis. If you'd like, feel free to pause and take a closer look, but you'll see basically the same thing again with much more detail in the next section. So let's now go into the spreadsheets. Okay, here on the spreadsheets is where I personally keep track of the combined portfolios of my TFSA and non-registered accounts. At the top here, we have the overview section, where you can see the day P&L and total P&L, along with the total return. This is just the current unrealized gains or losses between the two accounts on the current day, overall, and then all time. Next is the weighted average yield, which is right now at 20.82% overall. I find this to be a good balance and range, where there is a mix of yield while also keeping the total returns in mind. Then at the end, here is the annual dividends, or distributions that I can expect to receive each year. This changes with time as I contribute more to the portfolio, or reinvest the distributions I receive. The goal for this year, I think, is to get it to around $48,000 once the cash in my TFSA is fully invested and in the market. So there's still quite a ways to go, but I think we should get pretty close to it by the end of the year. Then the chart beneath is a visual of the portfolio value, total invested, and deposit amounts over time. This is to mainly see how close the portfolio value is to my deposits. Because once the portfolio value drops below my deposits, it means that I'm no longer profitable and would actually be losing money from my investments. For these next sections, I'll zoom in a bit so that it's easier to read and follow along. So first, we see that the combined portfolios together are currently valued at $232,011.09. In total, the deposits into the accounts equal $184,326.48. As for the total amount invested, we just passed the $200,000 threshold. Next is a section for the composition and how I categorize all of the holdings across the two portfolios. The exchange traded funds category is for more diversified or index-based types of holdings. So it's a fairly broad categorization, but a majority of these are in the core or TFSA portion of my allocation. After that, it's all of the single stock ETFs that I plan to hold and average into for the long term. Most of these are part of the Magnificent Seven, with a few others mixed in as well. Then we have the crypto category, where everything crypto related is listed. I mentioned it in my last video, but I plan to eventually get rid of CNYE from here, just so I can reduce a holding in the portfolio. It's already included in a few other ETFs, so I don't need to also own it individually as well. For my Canadian exposure, I've kept it very simple, and just have two ETFs here, InBank and ENCL. And lastly, I have a growth category, where these are strictly focused on price appreciation and don't use any covered calls. Scrolling down a bit, I have a chart breaking down my deposits and how my returns compare to it. Right now, the total return is only $47,687.55 out of a total $184,326.48 deposited. So it's not quite there yet to double my investments, but that's also because of the large amount I've now added to the TFSA. Here, you can see a screenshot from the last portfolio review and how it is much closer to matching my total deposited amount. That's okay though, as it's just part of the journey and growing a portfolio for the long term. But since that screenshot, we've seen the unrealized profit and loss dipping down slightly into the negatives due to the correction. I'm not worried, and we should see it come back into the positive very soon. The last section here is just a breakdown of returns based on the individual categories or sectors. As you can clearly see, the crypto sector isn't doing well obviously, but the distributions help offset some of the unrealized capital losses. For the best performing sector, it would be the technology sector. This is where most of my single stock ETF investments are, and shows that my core and satellite plan is working as intended. When compared to the exchange traded fund sector, which is the diversified or index-based type of holdings intended to match or slightly beat the indexes, the technology sector has outperformed it, despite having half the amount of invested capital. I would say the tech sector still has room to run, so in the future it should continue to outperform by an even larger amount. All of the other sectors here are also performing well, acting as stabilizers that are outside of tech and crypto. Now going back up a bit, we can look at the recent performance comparisons. This is probably my favorite part and section I look at the most on a daily basis, because it tells me the general trend in comparison to the S&P 500 index. Total returns and portfolio growth are my priority, so this helps to identify and gauge overall performance. In the past one day, it's underperformed, but this is due to the current sell-off in Netflix and ENCL shown here. I don't place too much emphasis on the one-day performance because of this reason, but if I'm noticing a consistent pattern, then that could eventually be an issue. On the 1 month, it has outperformed the index slightly by 0.47%, so it has kept up to the index at the very least. For the 3-month and 6-month, it has been an underperformance, but I would attribute that mostly due to the sharp decline that crypto had during those months. I would expect when there is a recovery in crypto, for the numbers here to eventually catch up and surpass the index. And you can kind of already see this is the case when you look at the year-to-date comparison, where the portfolio has almost doubled the performance of the index so far. So this gives me the confidence that things are working as intended, based on how I've put together the portfolios. As for the all-time return comparison, this one is going to look like the portfolio is greatly underperforming, but it's again due to all the new contributions made to the TFSA, and how the total returns are calculated. I'll put up an additional information box since I already have it made from previous videos, but it should hopefully explain it a bit more if you're interested. Now if this top section is something I look at for the trend, then this next section is where we get into some of the more nitty-gritty details. Here, I've ranked all my holdings based on a few different metrics, just so I can make sure that the portfolio is growing as intended. The first column is the allocation column, and this is important when it comes to understanding your portfolio's underlying exposure. Many people look at this from the point of view of the current value of the individual holding, but I actually look at it from the point of view of my initial invested capital. This is because what you invest into a position determines the volatility or movement that you experience, and also the impact it will have based on its individual performance. If you don't allocate properly and keep track of how much you've invested in each position, you could unknowingly overexpose yourself to bigger swings than you intended. A prime example of this could be looking at MSTE. Because it has traded down significantly, losing almost 80% of its value from the peak. If you go based on the current value, then it would have shrunk to a much smaller allocation overall in your portfolio. Not knowing this, you could mistake it as you are underinvested, and decide to put more into it, thereby increasing your portfolio's exposure to it. If it continues to fall, then you would see a more magnified loss, because you now have an even higher exposure to it with the newly invested capital. So by having this based on your initial invested capital, it allows you to mitigate risk more appropriately. For myself, all of my core holdings are going to sit here at the top of the list. These are long-term holds, and form the base of what I build the rest of my portfolio around. This middle section, between 3% and 5%, are going to be most of the single stock ETFs, or other holdings meant to help stabilize or diversify the portfolio a bit outside of just technology. And then for the bottom third of the list will be some of the more speculative or newer positions to the portfolio. Some of them I'll build up over time, and then others will probably stay in this section based on risk or other factors. The next column over is the total P&L, or unrealized gains and losses. It's not a column I look at too strictly for analysis, because it doesn't incorporate the distributions that were also paid. But it matters in the sense that a holding should have the potential to also provide some degree of growth to at least maintain the NAV. If it continues a downward trend, despite the underlying going up over a long period of time, then it would mean you're trading off a lot more returns by covering more of the portfolio for the income. There's a lot more detail I can get into for this, but I'll save it for another future video. As of now, the holdings are split basically half in the green and half in the red. The best performers are YGOG, Bank, and ACT. Google has done very well, and has been making new all-time highs over the past few months. I got into this position when I first started investing, and it just so happened that all of tech was down, so it was partly due to some great timing. Not much needs to be said about the Canadian banks, as they have outperformed the S&P 500 index over the past year, and still continues to outperform it so far year to date. For ACT, you'll have to do your own research on it, but this is a small cap position in a Canadian plastic waste recycling company that I've held for the last 3 years now. For the worst performers, they are MSHE, BCCL, and MSTE. Microsoft has been under a lot of pressure because of the AI threat towards software companies, but I think this can be seen instead as an opportunity to build a larger position. Then BCCL and MSTE are going to be because of Bitcoin's price dropping significantly since its most recent all-time high. I'm still continuing to add to these over time, but because of my current allocation size, I'm not adding any new capital to them and only using distributions to average down. In the next column is where I have the annual dividends of all the holdings. I'm not too fixated on this, as I've come to focus less and less on trying to maximize the yield. Instead, you should be basing your investment based on the actual underlying holdings or exposure. But there are some specific thresholds that I do look at when it comes to this column, and they are going to be in $1,200 increments. This is so that I know I'll be receiving at least $100 per month from that particular holding. So if I find one that is close to the next threshold, and it's also currently at a discount, then I'll look to add enough to it in order to reach that big round number. Otherwise, the biggest payers are QDay, HHIS, and BCCL. And then the ones at the bottom with dashes don't pay any distributions. Similarly, the next column is also for distributions, but it shows the lifetime amount I've received from each holding since owning it. Again, this isn't something I use for decision making, but is just a reflection of a particular holding's yield and duration in the portfolio. So we can see that TSLY and HHIS are at the top, and that's mostly due to their high yields, because they have been in the portfolio for a shorter amount of time when compared to Bank, QQCL, and ENCL just below them. Then the ones at the bottom with $0 are either because they don't pay distributions, or they are too new to the portfolio. Finally, we have the most important last column, which is for the total returns. I probably look at this one the most often as it reflects the true performance of each of the holdings by taking the unrealized gains or losses, and also adding all the distributions that I've received from each one. Overall, there are some great performers, with 2 of them having over 100% return so far, and quite a few returning 20% or above. A lot of these in the middle just recently flipped back into the green, after being down a bit due to the war. In my previous video, there were some comments about my holdings, specifically about owning HHIS, and then also the individual single stock that are already inside HHIS. If you look at the list and where each of these sit, you'll find HHIS with an 18.57% total return. This is great for a 1-year return, but some of the single stocks I have that are above it for performance would be YGOG, TSLY, and NVHE. For these ones, I've owned them for a while now, so they've had the time to outperform HHIS. In the case of METE, AMHE, GOGY, JPHE, Nefli, and MSHE, these are newer positions that I've only started in recent months or less than a year ago. So in time, I'd expect most of these to also eventually outpace HHIS in performance as well, while I build into them. With HHIS, you'll be getting the average performance of the underlying stocks, based on their allocation size. But by choosing individual stocks, I can look to pick ones at discounts and aim to get more outsized returns. It might not be for everyone, but it's what I enjoy doing and keeping a vibe on the markets. Then at the bottom, you're going to find all of my crypto holdings, except for HBTE, which has actually rebounded well and is a bit less correlated due to the underlying holdings in crypto miners. It might take a little while for these at the bottom to recover, but crypto has been showing some promise lately, trending upwards in the past month. I'm also not worried because despite being down a fair amount on them, they haven't been too damaging because they have been properly sized based on my own risk tolerance. So hopefully we can see some more meaningful recovery in crypto soon, and eventually have these go back into the green. Then the last section of this dashboard is going to be the projected monthly dividends, where it shows the monthly totals dating back to when I first started the accounts. At the start of the year, We had just crossed the $2,000 mark for monthly distributions. And since then, with all the new contributions, next month is going to be the first month we will see distributions over the $3,000 mark. I still have a bit of cash left to deploy, so I'm aiming for approximately $3,500 to $4,000 per month by the end of the year. So overall, I would say things are progressing as intended, and it shows through the performance that I've shown above. For all these portfolio review videos, I always try to remind myself that I should make them shorter and to stop including all these extra details, but I somehow always find more things to include. If you do happen to find this useful and want to keep following along to keep up with the journey, consider subscribing so you don't miss out on any future videos. Thanks for sticking around to the end of the video, and I'll see you in the next one.